Next is stop loss orders. These are used by amateur traders to manage risk. For some reason, amateur traders, retail traders, they come into the market, they put in a stop loss order, and they believe that they are managing, controlling, or reducing the risk in their positions, thus protecting their capital. Nothing is far from the truth. So, am I suggesting not to put in a stop loss order? Absolutely not. What do I mean? It will become clear in a while. All right. So, they will usually put them beyond visual references. Okay. Let's say market comes down, forms a swing low, goes higher, pulls back, and now again going higher. All the retail traders who bought this pullback, they will put a stop loss below this level. Stop loss sell order. They will put all their stop losses in this zone. Why? Because it is very easy to determine. It has been drummed into our heads that if you are buying at a particular level, you look at the next lower support or resistance and you put in your order there. So here the market turned. For some weird reason, we consider this as a support, and then we put our stop loss orders below that. And it is very, very easy to spot on a chart. Another common way of putting stop loss is a fixed money stop. Like if you are buying Nifty, you might put in a 25 or 50 point stop loss, expecting the markets to go higher than 100 points, 50 points, 60 points, 100 points to give you at least 1:1 or higher reward to risk ratio. That is another common way of putting a stop loss. But this way of putting a stop loss just below a very, very visual and easy to identify reference is how the amateur traders put their stop losses. These references are very, very obvious. And the smart traders are keeping a close watch on what these retail traders are doing. So what happens? Retail traders put their stop loss below such an obvious reference, expecting the prices to go higher. This does not happen. Prices slowly go down. This is your stop loss level. They hit it, spike down. Why? Because all these stop loss orders are there. As soon as the trigger is hit, a lot of market sell orders come into the exchange and they push the prices down rapidly. But once these stop losses are over, no fresh selling is coming into the market, and that is why oftentimes the market will reverse quickly and even close above this trigger level. And then a steady rise starts and it goes well beyond whatever target you had originally planned, and then you end up beating yourself why market did that to you, or you will start saying that market came down just to hit my stop loss. I'm extremely confident that many of you have felt like this at one time or other in your trading. And why I am so confident? Because I have felt like that. I have seen many traders who have felt like that, both struggling and expert traders. Everyone has had that feeling once. Why me? All right. And the reason is simple. If you are putting it at such a visual reference, smart money will use it to effect inventory transfer. They use it as an inventory transfer mechanism. What do you mean by inventory transfer mechanism? They will transfer good positions, okay? Good positions to their account, and bad positions to your account if you are a retail trader. So their whole objective is to trap amateur traders into bad positions and out of good ones. So you bought here, you put a stop loss here, you're expecting the prices to go higher. The prices were going to go higher. they actually did go higher. But were you enjoying that up move? No, because you got out in this area. So what they did, even though your buy position was a good trade, they trapped you out of it by hitting your stop loss. And then the market moved. Not only are stop loss orders placed here, there are traders who feel that market is going higher, it is coming back down, and once it breaks this support, it is going to go much lower. So what they do, instead of trying to find low risk opportunities like this or this to sell, they wait for the market to confirm a breakdown. So they put their stop loss sell orders here. What they want? They want to enter into a short trade as soon as it hits this day's low. So not only are long order stop losses like somebody has bought, so they have put in a stop loss sell order. Not only are these stop loss sell orders getting hit, fresh sell orders, fresh stop loss sell orders are also getting hit. What happens? You have put in a sell order below this support. You believe that market is going to tank below this support. As soon as prices come here, your order is executed. Prices go lower for a while. You feel excited, but then they go and they close above your entry price. Now what has happened? You are stuck in a bad position. Now the market will make a steady rise. You will say, okay, it will reverse from this swing low. Once it reaches here, you say, okay, it might test this swing low and then reverse. So if you have put a stop loss above this swing low, maybe you modify it here. As it starts approaching here, maybe you think that it will give a stop hunt, a spike above that and fail. So you remove your stop loss. Then it spikes above, but never comes back down, just continues higher. And then you are stuck with a big losing position. And I'm very, very confident that this also has happened to most of the traders. It has happened with me, and I'm very confident that at some point in your trading, you too have played with such flawed logic. So, first, if you were long in this zone, they trapped you out of it. If you wanted to short in this zone, they trapped you into it, into a bad position. That is the whole game the smart money is playing. They want to transfer good positions to their account, and they want to transfer bad positions to your account. Positions are buy or sell orders, or trades rather, because they will get executed. So buy and sell trades. If current market is going up or is going to go up, and the smart money is playing for from the long side, buy trades are good trades. But what they will do, they will transfer all the good trades to their account. And if the market is supposed to go up, then sell trades are bad trades. They will try to trap you into these bad positions. Make sense? So stop loss orders, when they get hit, they will enter the markets as aggressive orders only, because stop loss orders are market orders. We know market orders mean aggressive order. That is how the order flow software will make a distinction whether a order is aggressive or not. So here, when the stop loss sell orders are put into the market, all these orders will go into the market as aggressive sell orders. And they are often misinterpreted by traders as a sign of strength. They believe when it goes down and you see a lot of stacked sellers, amateur traders feel that this is a sign of strength, whereas it is actually a sign of weakness. It is a sign of stop hunt. Right? So this mechanism of putting in a stop loss order, a stop loss sell order, a stop loss buy order, they will go into the system as aggressive orders, but they are not always interpreted as signs of strength. All right. So it is extremely vital to learn how to make your own order book to be able to trade successfully. Because if you don't know what is happening around these references and how the smart money are playing these references, you will often enter into exactly wrong trades at exactly wrong time. And then you will keep wondering why you are not able to crack this code of trading and why you are not able to become consistently profitable. So these were stop loss orders. These are very, very crucial concepts, and we will bring it all together, okay, in a graphical format. So don't worry.